Hi, good afternoon. Thanks a lot for tuning in. It is Dan Kurz, DK Analytics. It is Monday, September 30th, 2019, the last day in September. This video is going to attempt to address, or my remarks, the economy. That QE is going to have to address a pronounced savings/liquidity crisis. And I'm also going to touch on the potential contrarian indicator significance, I think it is, of 50-year bonds being increasingly issued amidst a bond market bubble. The metrics that I'd like to briefly review, as is customary, are the trade-weighted dollar, the 10-year treasury, the S&P, oil, gold, and silver. Starting with a 10-year dollar index against the major currencies, OECD market currencies, it's hanging high at 92.79, still benefiting, I think, from the even more currency destructive announcements of other central banks. But when it becomes clear that the US Fed is going to have to do the biggest 180 of all, which I think still hasn't sunk in, it will turn the dollar's fortunes in terms of it coming under pressure against the other leading fiat currencies. And if you can't buy into that, then consider this. The dollar is akin to a negative free cash flow unit. And at the end of the day, it is the most dependent currency, the most dependent nation on sustained large foreign financing. And it is the biggest, the United States, the biggest debtor nation in the history of mankind. So if you continue to have to issue more debt, then obviously more of something forever and a day becomes less valuable, and the debt is the currency. And as this will continue going forwards, I think the dollar bubble will pop. But I am repeating myself. The 10-year treasury, still in a bull market. The yield earlier today at 1.69. Again, recessionary fears that are trampling over actual monetary inflation or default fears, the whole bond complex or massive indebtedness, and how central bankers will respond is currently not being addressed by those running into the security, quote unquote, of government bonds. And that holds true for other nations as well, obviously. The S&P 500, in stark contrast, near record highs, while the bond market fears recession. The stock market sees clear sailing ahead for the economy and for EPS growth. The two don't jive. And obviously, one of the two indicators is wrong. Or actually, I would suggest that they're actually both incorrect, because bonds ought to reflect the indebtedness and the related monetary inflation risks that are around the corner, even more than we've seen. And stocks ought to reflect what is going to be a massive compression in earnings power and EPS. Shifting to oil. Oil at 55.25, it got a huge boost the other week thanks to an assumed Iranian strike of major Saudi oil facility infrastructure. That didn't prove to be as bad as was initially thought, and oil backpedaled, but it is still, considering the weak state of the global economy, and I'll get into that, is hanging high, I would say, and I think that has two good sustainable reasons, at least on a strategic trajectory, and those are supply constraints. Notwithstanding the huge increase in US-based oil thanks to one or another form of fracking, which has been very unprofitable from the get-go, hugely cash flow negative as an industry. This has pushed the global supply up even more, but I think that's going to end up being a boomerang as this eventually subsides and sharply, and thus we're going to have an even tighter oil supply situation. Moreover, oil is a real tangible asset that I'm going to argue will be sought after as it becomes clearer and clearer that the central planners, central bankers will go to any length at all to destroy their currencies to maintain the status quo. Lastly, in terms of these valuation metrics, I'm sure that any of you that are involved in precious metals have seen a sharp pullback from recent highs in gold, which earlier today went below 1,500 per troy ounce. I saw it at 1,480, a strong decline. Silver, even weaker. It went up even more, down at $17.11 per troy ounce in US dollar terms. A correction of 13% or so from the 1950 it briefly reached. But I think both of these metals have corrected to a large degree, possibly due to the paper imaginations of the various exchanges that are in effect selling in naked terms gold, silver, punishing the price. In essence, what we've got is the derivative dog wagging the underlying asset. I'm sorry, the derivative tail wagging the underlying asset dog. It's supposed to be the dog that wags the tail, is my point. Let me shift to the economy. September data releases largely added insult to August injury, as detailed in last month's video, coming unglued with ever greater speed. That trade war, Mr. Trump, it is unfortunately doing great things to help usher in the inevitable. To wit, earlier this month, the ISM for Manufacturing Index contracted for the first time in 3 years, also falling to the lowest level in at least 3 years. Let me bring this on the camera here. There we go. We're talking about this steep fall off. Very rapid and steep fall off below 50 into contraction territory, right? And simultaneously the orders, which is a component of this whole index, also skidding. So this does not suggest a stout manufacturing sector. Let me turn to what this tells us. It tells us that the sustained strength or nominal strength in the U.S. economy, if it isn't manufacturing based, it has to be, and you probably guessed it, a consumption binge by the U.S. government on the one hand and the U.S. consumer on the other. Yet consumers are starting to spend less than projected, perhaps best evidenced by the record 8,000 store closings year to date in the United States. Spending out of an empty pocket is unsustainable. I would argue there is nothing fundamentally good going on in terms of the U.S. economy's trajectory. No materially higher savings, no robust capex. In fact, U.S. companies just cut capital spending. I don't see a manufacturing revival. I think I addressed that and going to show you another chart to fortify that take. I see more of a lingering corporate anorexia / stock buyback triggered shrinkage spiked in the past year or two with tariff spawned shrinkage. Said differently, just more of the same excesses that got us into deep doo-doo in the first place, heightened by a spreading trade war. In this regard, note that the real manufacturing output, which substantially overstates output because government's inflation statistics substantially understate inflation, was still below the Q4 07 peak prior to the so-called Great Recession in the second quarter of this year. In other words, some 11 and a half years later. Let me see if I can get that chart here onto the picture. As I have a piece of paper that flew away here thanks to a fan that I've got on, my apologies. Here is the U.S. real output index, right? We're talking about this high, right, before the Great Recession in Q4 07. It fell off the cliff, and we've been coming back. But the current Q2 level right here is below what it was in Q4 07, Q2 19 below Q4 07. We did briefly exceed it here for a second, but it's already rolling over. And this, I would argue, is not a stout manufacturing revival, especially not if we include one or two other thoughts into this picture. And those thoughts are the following. As manufacturing is hard-pressed to punch out higher real numbers, all sector U.S. debt since Q4 07 is up a stunning 20.8 trillion, and the S&P has more than doubled from late 07 before plunging in 08 and into early 09 by over 50%. I remember it well. Noteworthy is the vicious bear stock market in 08 into early 09 lagged increasingly ample signs that the real economy from 06 into late 07, from housing to manufacturing, was headed south. The stock market has gone from a leading to a lagging indicator due, of course, to sustained and increasingly massive global financial repression, which the world's central banker currency destroyers / debt enablers are about to double down on. Look for the same again this time around, and then some. In other words, the stock market is once again shrugging off or lagging progressively and sustainably weaker economic fundamentals until it suddenly doesn't. And then look out below. It will have a lot of catching up to do to the downside. Speaking of doo-doo in terms of coincident to lagging indicators, orders for heavy trucks continued to weaken substantially as recorded earlier this month. Check out this chart, which I managed to fish back to present here as it flew away. It is courtesy of the FTR Transportation Intelligence and Wolf Street. Let me see if I can get this up. Okay. Here we are. Here's this stout rally into 18 where we literally had up to 180% increase in orders for Class 8 trucks, 18-wheelers, the big trucks that do the hauling. And then all of a sudden we've gone into pretty pronounced weakness, all right, since in essence early 19. Now I have some thoughts as to why we have this progression, and you probably won't be surprised when you listen to what I have to say. This coincident to lagging, highly cyclical indicator called 18-wheeler or Class 8 truck orders reflects the current state of the U.S. economy in terms of how much demand there is to move goods from A to B. It also reflects distribution center inventory levels. It also reflects freight capacity utilization levels and fleet age. And it also reflects truck construction lead times. And last but not least, and this is the cyclical aspect of it, it reflects the propensity to over-order and to under-order. As concerns the currently crashing truck order cycle, I'd argue that this time around, the boom extending from early 17 through late 2018, all right, I'm talking about this humongous boom, all right, and then falling off the cliff at the beginning of 19 into stoutly negative numbers from 180 plus to 80 minus. Those crashing numbers in the current truck cycle was materially, the truck ordering cycle, I'm sorry, was materially spiked / distorted by, you guessed it, Trump's trade war tariffs. How so? Because manufacturers were justifiably concerned and convinced, and rightly so, that imported raw materials and the related component parts would be getting more expensive thanks to the trade war. So they overstocked inventory, stoking the transportation sector and 18-wheeler truck orders. Well, this is starting to unwind. So not only do you have lower consumer demand, but you have to get out of an over-inventoried state. So we're going to have the opposite, which will exert additional pressure on economic growth. Given America's $900 billion plus annual goods deficit with the rest of the world, $900 billion plus, and its huge annual trade deficit with China in particular of nearly $420 billion, nearly half, inventory calculations, that is, can we beat the tariffs, were anything but a detail. The takeaway is the following. Not only has Trump's trade war failed to stoke U.S. manufacturing, as I hope I've shown with some conviction or good evidence, but it has dented global manufacturing thanks to trade war uncertainty. It has increasingly raised the imported portion of U.S. manufacturers' cost of goods sold, which is a very sizable portion, and it has spawned tit-for-tat tariff responses by China and increasingly other nations, especially European ones. In short, Trump's trade war is wreaking havoc on a deeply interlaced global supply chain, something I have drawn to your attention in 2 of my last 3 videos, and well before then in various posts. I mean, seriously, hasn't anyone at the White House learned anything? Namely that the more you mess with economic Mother Nature, most especially trade, the worse the results will be? Mr. Trump, you are no more capable than all the other central planners, so please go read The Wealth of Nations by Adam Smith, and let's focus first and foremost on what's not right in our backyard. I've gone into this in great detail, so I'll spare you, instead of pointing fingers overseas all the time. Because that's where we'll thankfully find in our backyard the greatest potential for trade deficit reduction. And often said, if other high wage, high or expensive currency countries, most especially Japan, Germany, and Switzerland, can run sustained trade deficits or balance trade with China, then don't tell me that they can do it and America can't if America tends to its own backyard. What I'm trying to say is Mr. Trump would be doing himself a lot of good, and also for his credibility, also for his re-election prospects, and the rest of us deeply concerned about a Marxist democratic takeover of the White House if he would stay honest and go with the truth instead of sound bites. Same goes eventually for U.S. manufacturing revival and our balance of trade. Most of this is domestically caused and thankfully can be domestically addressed if the will is there, right? But it will take time, and that's the problem. It doesn't make for shock and awe, right? Alas. To sum up, central planners, aka bureaucrats, are extending their reach beyond central banking-based currency destruction, affordable 24/7 energy-based destruction, property diminishing regulatory insanity, and national sovereignty evisceration. And I might also say national solvency evisceration. Specifically, the bureaucrats will now seek to destroy, thanks to Trump's lead, the very global supply chain that enables national economic output in the first place. As I've asked numerous times, do we really need to revisit Smoot-Hawley and Hooverism in a day and age when nearly 60% of global output is international trade-based? That's twice or more what it was back in the day when Smoot-Hawley caused global depression. Fortunately, even economic illiterate Trump seems to be realizing and even admitting during periods of weakness or moments of weakness or honesty, pick your poison, that it is the U.S. consumer that depends substantially upon Chinese imports in order to fill his or her Walmart shopping cart, to purchase a new cell phone, and to enjoy a present-laden Christmas, both in terms of availability and affordability. And I thought, Mr. Trump, that the Chinese paid for the tariffs and that there were tons of other manufacturers from other nations to source from. Is this why Trump recently exempted 400 Chinese goods from U.S. tariffs? Goods such as rail car parts, motorcycles, solar panels, dog leashes, electrical tape, and power tools. Now, Trump being Trump, maybe these will be reinstated next week or next month, or maybe, make that nearly certainly, he'll, Trump, do anything to keep the big, fat, and ugly U.S. stock market bubble going, including no longer fearing intellectual property theft while simultaneously promoting the Chinese manufacturing giant that is the U.S. equity market kingpin, namely Apple. The point is, however unpredictable this off-again, on-again trade war is, it has already massively and negatively impacted the global supply chain. It has triggered inventory hoarding. It has caused tremendous uncertainty, in the process chilling capex, expansion, and hiring decisions, and thus chilling manufacturing in the process. This is the sober takeaway from the central planning nightmare from the past. Smoot-Hawley revisit, Hooverism revisited. Dear economic illiterate, trade crony drenched White House, all right? Once again, not how to improve your election chances, Mr. Trump. That is by hurrying along unnecessarily a budding recession. In stark and highly constructive contrast, I would be less than inclusive if I didn't also state that President Trump has been herculean in terms of his typically stout constitutional judge appointments and in terms of trying to reestablish domestic sovereignty, including on the southern border. That is the concept of a nation state, and more broadly in terms of policy, immigration policy. Trump spoke very elegantly, powerfully, and boldly about this last week in front of the biggest pack of globalists slash redistributionists, the UN diplomats assembled in his hometown, New York City. How so? With presidential remarks such as these. Quote, "The future does not belong to globalists. The future belongs to patriots. The future belongs to sovereign and independent nations who protect their citizens, respect their neighbors, and honor the differences that make each country special and unique." Stout and true stuff, in my opinion. If only the same Donald Trump was at the fiscal and economic policy execution steering wheel. If only he spent as much of his prodigious, endless energy and political capital on reducing government spending instead of signing bills to bloat government spending to one record after the other as both deficits and debt soar. Trump campaigned on shrinking government, which is the only real way to drain the swamp. He touted that a balanced federal budget within 4 to 8 years would be in his grasp as president. Instead, we have a rising sea of red ink and a few trillion more in government debt. The looming fiscal insolvency, coupled with a border crisis, are the biggest and most destabilizing and impoverishing dangers facing this country and its citizens, and I might add other OECD countries and citizens. If only Trump would also focus on our looming fiscal train wreck slash insolvency, but with a swamp cabinet filled with Goldman Sachs cronies and warmongering neocons, I won't be holding my breath, will you? Speaking of dangers, the Chinese are apt to say that a crisis or danger is also an opportunity. In fact, I think they have a word for it that doesn't have an equivalent in Western or Latin languages, but rest assured, I'll spare you. I won't try to pronounce it. But what I want to say is that opportunity that we have is an allocation or reallocation opportunity. In short, I know I sound like a broken record, but get out of overvalued stocks, bonds, and real estate and into safe cash like T-bills. They can print the money and you're not susceptible to interest rate increases because there is no interest rate, into attractively valued scarce and vital real assets that can't be printed, led by the ag and energy patches, and purchase today's very attractively valued precious metals that you house outside of the banking system so that they, your gold and silver, can't be bailed in. In the meantime, and reverting back to manufacturing and related big dollar consumer spending, big dollar in euro and yen and other currency terms, Europe's economy is going from weakness to weakness as car industry woes deepen. New EU car registrations fell by 8.4% in August, the steepest decline this year. Meanwhile, Asian vehicle sales are declining even much more substantially. In China, for example, vehicle sales are down materially in the past 14 or 15 months, while vehicle sales in India are collapsing, falling by 49% in August 2019 year over year. Given the huge multiplier impact of the auto industry on GDP, this is sobering. Meanwhile, the Japanese economy faces export headwind. Japanese August exports fell by 8.2% year over year. The ninth, let me see if I can do this. Yes, I can. The ninth straight decline dragged down by, you guessed it, autos, car parts, and semiconductor production equipment. Now, given that exports accounted for 18% of Japanese GDP, this isn't something that one can sweep aside. Let me now shift to the much discussed repo issue, and what I think is the real takeaway when one peels back the layers of the onion. The usually stable repo market, repo is of course short for repurchase agreement, is where banks turn for short-term loans when they need extra cash. Interest rates in this overnight market, or the cost of short-term funds, are supposed to mimic the U.S. Fed funds rate as determined by the Fed, which was recently lowered by another 25 basis points to an effective 2.13%. A sudden shortage of private sector liquidity a few weeks ago prompted buyers to bid up loan prices, which had the repo rate briefly surge to 10%. The jump prompted the Fed to intervene directly in the market for the first time since before the great financial crash over 10 years ago. Why? Why did it intervene? Because it wanted to return the status quo, that is, reassume control over short-term interest rates. In so doing, the Fed has pumped $200 billion into the system to bring the repo rate to heel with the Fed funds rate. Why did it have to do this? Because overnight loan rates have stubbornly refused to heel like a dog heels to the central planner's diktat/usurpation of private market-based interest rates, right? And that is also known as the Fed funds rate. This is, in my opinion, the struggle to contain the short-term cost of funding is a precursor to a return to QE or broader QE. If the Fed has to continue to extend liquidity to get the repo rate to heel with the Fed funds rate by assuring the repo market that overnight funds are in ample supply, doesn't this indicate that the opposite is true, thus mandating sustained outsized Fed funding commitments? What's the real fly in the ointment here? I'd posit that it is a financial repression-induced dearth of savings thanks to sustained yield starvation. America and the world at large have long had little incentive to save, with negative nominal yields even in the last few years, and even more negative real yields. That is after real-world inflation yields. This is especially true if one considers that real-world inflation is substantially higher than the government inflation stats. This is largely why the yield deprivation, the yield starvation, why the savings rate in the U.S. as a percent of disposable income went from double digits decades ago, when there used to be attractive rates of return on invested cash balances, to single digits. So we went from double digits to single digits in the US savings rate as a percent of disposable income. And the same has happened in Japan. Of course, societal aging also plays a role here in terms of pulling down the savings rate, especially, and this is key, if there are no yields for pensioners who have to deplete savings in order to make ends meet. If you are disenfranchised for saving, you do less of it, which also means that less can be invested by definition. And investment is ultimately financed by savings, not perpetually by debt printed into existence, which only works until confidence in counterfeit currencies crumbles, which has happened throughout history each and every time. So how do economies maintain their capital stocks, I ask, and what does this portend for both productivity and output, especially as financial repression-induced yield deprivation fuels, no, it rewards, stock buybacks and corporate anorexia / weak capital spending over stout capital spending and an organic growth focus. No wealth of nations trajectory here, that's for sure, which is exactly the Grand Canyon-sized problem. At the same time, as regards the repo rate that refuses to heal, the Fed's QT, or bond sales, and the $387 billion drawdown of excess bank reserves held at the Fed, coupled with materially reduced interest rate paid banks on excess reserves, money they park at the Fed, has only worsened what some people are referring to as a liquidity crisis. But I think this misses the point. The fomenting crisis is really just a decade-old ZIRP, NIRP, QE, that is zero interest rate, negative interest rate policy, and QE, or balance sheet expansion induced savings crunch, juxtaposed against unparalleled global debt and debt growth. The same financial repression has also spawned, as we well know, unprecedented pension underfunding thanks to sustained yield starvation heaped on top of massive pension plan underfunding amidst ludicrous benefit promises and rising life expectancies. My bigger point, it is the Fed's and other central banks' very policies that are threatening to produce liquidity and pension fund crises. In addition, what with money center banks, balance sheets stuffed with increasingly questionable value at risk loans, simply due to the massively rising global debt, the money center banks' massive derivatives exposure, and underfunded commitments virtually everywhere you look, while bad economic news continues to heavily outweigh good news on a global basis, is it any wonder that the Fed is having trouble keeping the market from raising the cost of short-term borrowing to reflect the real risks? This is also precisely why the Fed will need to double down on financial repression. What does this mean? It means that QE, or balance sheet expansion, or open market operations, or traditional central banking 101, central bankers will have us believe, or MMT, or whatever they want to call it to hide that it is still QE, or purchasing debt with money created out of thin air, or banana republic style monetization, QE will have to be massively expanded. Why? Because our free market capital suffocating, toxic, statist public policy stew is underwritten by the very money printing that America's framers, by insisting on constitutionally mandated precious metal-based currency, sought to avoid. And they did this so that their prodigy could avoid our current predicament, alas. And recall, QE, or asset purchases, were only supposed to be an emergency measure, not permanent Banana Republic style debt monetization. That is, sustained purchases of debt with money printed out of thin air until a currency is totally debased / worthless / destroyed. Speaking of which, the US dollar, using heavily understated, gimmicked US government inflation statistics, has lost 96% of its purchasing power, according to US statisticians, since the Fed was created in 1913. Yet recall that the 4% stub can still decline by 100%. And that's what's so important not to forget. In other words, it can go from 4 to virtually 0 purchasing power. This is where we are going. Make no mistake about it. And in hockey stick fashion, all of a sudden we're up and away, both in purchasing power terms and in terms of the fiat dollar measured against gold and silver. Needless to say, this will also hold true for the rest of the world's counterfeit currencies, as gold and silver are already displaying even more loudly than in the US dollar. With the Fed having drained a relatively small part of its balance sheet, and overall liquidity dependent more on money printing than on savings, which have been sliding for a long time, largely in sympathy with yield deprivation and negative real yields, the explosion in the repo rate really reflects the dearth of savings at the end of the day, doesn't it? In tandem, it also reflects huge productivity eviscerating misallocations that financial repression has wrought, which has constrained national income and GDP growth, which are but two sides of the same coin. This is the real point. Said differently, the massive debt buildup, both globally and domestically, are mirror images of the low savings and plummeting productivity, which once again are the prodigy of our toxic statist public policy stew, made possible solely due to money printing. What's the repo takeaway? The Fed had to print liquidity out of thin air that the system needed, which the free market could easily have provided had there been adequate incentives to save and invest in organic growth, meaning interest rates which would have consistently offered positive real rates of return instead of negative ones, as used to be the case prior to globally synchronized financial repression, which started some 10 or 11 years ago. In my opinion, the Fed's repo market action here is a preview of coming much larger currency debasement in the wings, which will eventually lay to waste fiat currency bonds, and as stocks are tied to the discount rate hip to bonds, stocks as well, at least the vast majority, with some exceptions where the stocks represent ownership in scarce, vital, real assets, resources. This is the repo issue that many talking heads are missing, in my view. The repo canary in the coal mine, if you will. In the interim, we all know that global currency debasement contests are blooming, whether via interest rates that the central banks directly control, which they have pushed below zero in Japan and Europe, with even more creditor eviscerating policies in the pipeline, or via their QE/money printing efforts to engineer lower rates on longer maturities. This threatens to make America's repo rate refusing to yield to the Fed's cost of funding diktat look like a shot across the bow or a preview of coming global attractions. Speaking of the devil, the 800-pound central planning gorilla, the Fed, is about to take center stage for its deep dive into unparalleled dollar debasement because the very kleptocrats that have increasingly trampled free market capitalism and price discovery, the ones running the system, the show, will insist on it. They, the kleptocrats, don't want to lose their power, their prestige, their star status, right, Sir Alan, nor their misgotten wealth. The impact of yield deprivation and financial repression is by now well known. Just ask Japan. It is as well known as it is destructive, for it weakens growth and expands wealth and income gaps. How so? By enabling and sustaining, as mentioned, corporate welfare policies of increasingly unrepresentative Western governments, which keep on marginalizing Main Street, maker property rights, free market capitalism, savings, and sound allocations. That same financial repression also finances massive redistributionism and third world amnesty. Financial repression, beyond raping creditors, obviously also enables growing and deficitary government spending, which transfers property from the rightful owners to the takers that will help ensure re-election. Call it legalized theft. Call it an evil racket. Call it unconstitutional. It's what the framers sought to avoid. Call it bankrupting. And we're about to double down on it. The unelected, unaccountable, unrepresentative bureaucrats, whether they sit in Washington, D.C., or in Brussels or in Tokyo, together with elected politicians that refuse to constrain them from usurping legislative powers, are to blame, as are, sadly and soberingly, the voters that elect and re-elect these politicians. For flavor, and to repeat, the cost of regulatory compliance in the U.S., as compiled for 2017, last year on record, by the U.S. Commerce Department's Bureau of Economic Analysis, was the cost of regulatory compliance in the U.S. was a stunning $1.9 trillion a year. Previously, there was a figure of $2 trillion. Well, let's take this last number, 1.9 trillion. This cost was imposed by some 2 million federal bureaucrats, and it represents about 9% of U.S. GDP. Let's see some back-of-the-envelope numbers. Each federal bureaucrat's de facto regulatory cost compliance footprint is a whopping $900,000 per annum. And this is before annual federal bureaucrat compensation and benefits that tower over the private sector's level by about 35 to 40%. We're talking about annual federal bureaucrat compensation and benefits of $100,000, north of $100,000. That's quite the private property transferring racket, financed by shareholders, by taxpayers, and by future generations yet unborn, or some 1 million per annum per federal bureaucrat. And this whole jig is run for, or primarily run for, the benefit of elitist statists, rhino cronies, and Marxist Democrats, all of whom are sadly into open borders / balkanization for the benefit of their own constituencies. Working American deplorables be damned. I think this theme echoes widely in the UK and in much of the rest of the OECD world. And those attacking this solvency and sovereignty rape are rudely called populists by our kleptocrats. They have no shame as they line their pockets and continue to disenfranchise us. Just think Brexit, not. Let me now turn to the 50 and 100-year government bonds being issued with increasing frequency, what I consider to be a major contrarian indicator. Heaped on top of the political, social, financial, and economic insanity juxtaposed against negative, nominal, and deeply negative real interest rates, we may be looking straight at the ultimate contrarian indicator, namely the rise of 50 and even 100-year bonds. Recently, some 12 trillion in securities, bonds, around the world were trading at negative yields. Now, this is down from 17 trillion in July, but that's still 12 trillion. Plus, central bankers are busy trying to outdo each other with new QE intentions or announcements, suggesting that demand for bonds will remain artificially robust thanks to printing digital money out of thin air. Amidst our unprecedented global bond bubble, Austria this summer, just ended, issued another 100-year ultra-low yield bond. It placed 1.25 billion euros at a 1.17 interest rate, a mere 50 basis points, 0.5 percentage points above the yield on its 30-year bond. In 2017, Austria floated a 3.5 billion 100-year bond at a yield of 2.1. Not to be outdone, Germany, earlier this month, sold 30-year bonds that pay no interest. Investors lent the money for 3 decades for nothing, even though the auction was undersubscribed. In 2016, Belgium and Ireland raised 100 million euros with 100-year bonds after Canada floated a 50-year Canadian dollar bond in 2014. Well, the U.S. Treasury, by possibly issuing a 50-year bond with which to test the waters, wants to get in on this creditor rape bandwagon before it disappears. Investors, especially insurers in Europe and Japan, are starved for high-quality government securities with positive yields, as negative yields spread around the world. With 12 trillion in negative interest rates globally, the worry that a 50-year treasury might crowd out the 30-year treasury is less salient for the moment than it was a couple years ago. From a debtor's perspective, if not now, when should one secure free long-term financing, at least in real terms, and in some cases, as in Germany, even nominal terms? Should one do this after debt to GDP increases even more? Should one do it after bond investors finally revolt and wake up? Or after the bond vigilantes sell, given fear of unparalleled defaults and or inflation risks, which, as you know, are tied at the hip in fiat currency nations wielding a printing press? Could the issuance of a 50-year U.S. bond be the ultimate contrarian indicator? I think so. The biggest canary in a coal mine about to keel over. The growing issuance of 50 to 100-year bonds at a time when the global bond market is in a 38-year bull market defined by unprecedented bubble offering steeply negative nominal and real yields, despite unprecedented insolvency and inflation risks. Well, This growing issuance, juxtaposed against all that, is, I would argue, truly eye-popping and, again, likely a great contrarian indicator. For the sake of interest, in terms of capital at risk, let's do some basic interest rate math. Say the Treasury was able to float a 2.5% 50-year bond. Afterwards, let's say 10-year Treasuries revert to an average yield over centuries of about 4.5% from today's 1.7%. What would happen to a 50-year Treasury with a redemption value of 100, which was issued with a coupon of 2.5%, assuming a similar step up in the yield as the 10-year, in this case to 5.3%? Excuse me one moment. Sorry, I had some equipment failure over here. In such a world, the 50-year bond would plummet from the issue value of 100 to 51.2. That is, if in synchronization with the 10-year, which went to 4.5% from 1.7%, if the 50-year went from the current 2.5% coupon to an interest rate required of 5.3 or 4.5 plus 0.8%, that kind of world would have that 50-year bond plummet from 100 to 51.2. In short, just about falling in half. If we had reversion beyond the mean, which always happens, as I've stated many times, what would those bonds be valued at, assuming long bond yields shot back up to 8%? That 50-year bond, again, assuming the same 0.8% step up in yield to a 10-year Treasury requiring an 8% yield, or in this case, a 8.8% yield on the 50, that bond issued at 100 with a 2.5% payment to maturity interest rate would plummet from 100 to 29.5. And what if we revisited 15% plus 10 and 30-year Treasury bond yields in early 81, a time when the U.S. was a net creditor nation and only had 31% public sector debt to GDP instead of 103% currently? That 2.5% payment to maturity 50-year bond would tank from its issue value of 100 to 15.9. Talk about capital at risk. Talk about investors being locked into 50-year bonds yielding a pathetic 2.5%, while currency debasement, otherwise known as inflation, blossoms, and your pathetic bond income or payment to maturity becomes even more pathetic. That is, unless you take a huge capital loss. Talk about a 1-2 punch. Talk about a perfect contrarian indicator. The issuance of record low yielding government debt, even as both default and monetary inflation risks are globally unprecedented. By the way, excuse the earlier noise or disruption. I grew up Catholic, so a brief confession. I have a cat here that's sitting comfortably in the background that decided to move. Now, allow me a few local and national closing remarks. First, an observation. Substitute teachers, which includes yours truly, need to take yearly mini courses and exams. There's 8 of them this year. I believe 1 more than last year. Bureaucratic insanity and lots of CYA by Lee County is going on in my view. Discouragingly, there was also a diversity awareness exam, that is course and quiz this year. In typically destructive, and I would argue depraved manner, the course explained how staff was to relate to LGBTQ kids. That is, how to relate to lesbian, gay, bisexual, transsexual, and questioning kids in public schools from K to 12. How many kids out of 100 fit into such categories? I mean, really. What's next? Genderless pronouns forced upon the staff? This isn't diversity awareness, in my view. This is politically driven, contrived diversity insanity that can be minority diversity tyranny at the expense of the majority and common sense shriveling, right? And possibly, if carried to an extreme over time, it could be at the expense of a functional, tolerant society which respects privacy and thus offers true diversity and respect for the individual, and I might also add tolerance, because that's an essential part of respecting privacy. To add insult to injury, such diversity awareness may end up artificially drawing attention to a fabricated issue, which could artificially incite bullies, causing manufactured trouble. Meanwhile, and at another level, the local county school bureaucracy has fired lots of teachers while continuing to expand its own ranks, at least based upon my school-by-school observations of bureaucrats at the local schools. This has bloated class sizes, firing a substantial number of teachers, even as new non-English speaking students from south of the border continue to pour in. South of the border students typically constitute the vast majority of the school student populations in the southern part of my county already, by the way. Most substitute teachers here, meanwhile, net about $13 an hour. They have to comply with all of the county education department rules and regulations, yet they are deprived of both the per-hour salary and per-hour benefits that full-time public sector teachers get. Call it regulatory insourcing with outsourced compensation. Perhaps a microcosm of what ails so many American deplorables such as myself. In a related manner, and at the national level, consider that the annual health care insurance costs for the average American family have been surging since John Roberts decided to bastardize the Commerce Clause of the Constitution to force Americans into government-orchestrated health care insurance. Governmentally regulated health insurance has sent premiums rocketing higher for many years. This is thanks to the massive redistribution and insurance pool distortion, the healthy opt-out, that Obamacare has wrought. In fact, the average American family's annual health care insurance has risen to a new record, a whopping $20,000 per annum on average. The ever-rising premiums have forced an increasing number of Americans to drop coverage, yet the statistical flunkies working for Uncle Sam tell us that we have about a 2% rise in the cost of our services and goods. Hitting the spot, the CEO of the Kaiser Family Foundation recently called annual health care insurance costs akin to buying a new economy car, but each and every year. To put this into context, reflect on the fact that the median U.S. household income in 2018 was just shy of $62,000, according to the U.S. Census Bureau, which begs the question, how can Main Street fund overall spending if ballooning healthcare insurance costs constitute 32% of average household income by themselves? How can households spend more? That is, other than by taking on more debt. And at some point you run out of runway. Staying at the national level, think what would happen to our economy what remains of free market capitalism, earnings, property protections, and the stock and bond valuations if, on top of the inflationary Fed, the redistributionism that's rampant, the Democratic trial lawyers, shakedown artists, and the super high legal costs of U.S. companies, and the bureaucrats extracting $1.9 trillion annually out of owner skins for compliance. Think what would happen if on top of all that, one of the foaming at the mouth socialist / Marxist Democrats, whether it's Elizabeth Warren, Bernie, Kamala Harris, or Cory Booker, think if one of these people become America's next president. This would be all the more true if he or she, the disaster that would occur, were able to keep the House in Democratic hands and possibly even flip the Senate into Democratic hands. Stranger things have happened during tough economic times. Just think about the highly destructive Roosevelt and the lingering and material damage he inflicted on the domestic economy through massive intervention beyond the war effort. He kept creative destruction from working its rejuvenating magic, much like what happens in the aftermath of a forest fire for up to a decade. We never had that necessary forest fire. How would one spell going from bad, the current political situation, the current office holders, to downright impossible? Is anyone dialing this risk into bond and stock valuations? In America? I don't think so. Is this priced in anywhere in the U.S. capital market? How about no? How do I know? Just look at the puny bond yields and the stretch PEs ahead of an earnings compression, an EPS compression. As I have said, we are already overdue for a 50% plus EPS implosion and a very stout, lingering recession based on our massive debt, $73 trillion in the U.S. alone, some 3.4 times GDP, based on our financial repression-based misallocations and our plummeting productivity growth and our yield deprivation caused lacking savings. Imagine if you spike all that with a Democratic takeover of the White House. Unfortunately, the out of the closet leftist kooks running for president can't be dismissed, which tells you a lot about the fabric of our society, and it's not all good. It also makes you think of the old adage, one that I keep repeating, concerning presidential elections, and numerous congressional ones as well. People, that is voters, vote their wallets, their pocketbooks. If an economy is in a recession and they feel it, they'll typically blame the incumbent and simply vote for the other guy or the other gal, which would likely mean goodbye President Trump. And good night, stockholders, good night, bondholders, because you will be fleeced. And the economy will do even worse, infinitely worse, obviously. None of this is priced in. Meanwhile, never forget that the Fed will go into ever more egregious debt monetization / currency destruction to pay for it all. That is, until confidence in its counterfeit currency is lost, which is why you need to be your own precious metal central bank. How is this for allocation food for thought? Too long, I know, but hopefully something you can hang your hat on, or at least consider as you look at your assets, your investable assets. Hope you got something out of this. In closing, let me state that September has been quite a reflective month for me, because this September is the 4-year anniversary since I started this micro channel as a tangential marketing effort related to a Southwest Florida JV that was ongoing until my erstwhile partner wanted to end our well spelled out collaboration. In the interim, the DK Analytics microchannel, this, has morphed into my main content course. Actually, since last October, as I detailed in my last post published on October 25th, 2018, it is my only course for time and monetary reasons. I will continue to publish, or I will endeavor to keep chiming in now and then in video format to the extent that it makes any sense. This is Dan Kerr's DK Analytics. It is September 30th, 2019. Thanks a lot for listening. Over and